Welcome to Talk Tickers. So you've got this earnings report from Cricut, and on the surface, it looks absolutely fantastic, a huge beat. But then you look at the stock price, and it just tanked. What on earth is going on here? Well, in this explainer, we're going to dig way past those headlines and figure out exactly what's got Wall Street so spooked.
All right, so here's the game plan. We're going to start with those headline numbers that looked so good. Then we'll dive into the market's, well, pretty weird reaction. After that, we'll get into the real meat of it. Cricut's kind of split personality as a business, and the big, scary tariff headwind everyone's talking about. And of course, we'll wrap it all up with our final verdict and even a little trade idea for you. All right, let's kick things off with the headline beat. And look, on the surface, Cricut absolutely knocked it out of the park this quarter. The numbers were objectively strong, way better than what Wall Street was expecting.
So let's start with the bottom line, right? Earnings per share. They came in at 10 cents. Now get this, that's not just a little beat. That is double what they did last year. It's a full 5 cents higher than what analysts were calling for. I mean, that's a clean 100% beat. You really can't ask for much better than that.
And it wasn't just the earnings. The top line, the revenue, was just as impressive. We're talking $170.4 million. That completely crushed the consensus estimate by about $13 million. So, let's recap. A massive beat on earnings, a huge beat on sales. This should have been a party for the stock, right?
So that brings us right to the million-dollar question, doesn't it? If everything looks so rosy, why in the world did the stock fall off a cliff?
Okay, let's dig into that market reaction. Because instead of popping champagne corks, investors basically ran for the exits. They didn't see good news. They saw something to be worried about, and they acted fast.
And here's the proof. The very next day, the stock closed down over 5%. And this wasn't just a little dip, it was on heavy volume, which tells you people were serious about selling. The market just wasn't buying what Cricut was selling, which means we have to dig deeper.
And once you start digging, you find the first big clue. You see, Cricut isn't really one single business. It's more like a tale of two businesses living under the same roof. And the problem is, they are pulling in completely opposite directions.
Okay, so on one side, you've got the platform business. This is the good stuff, the high margin, recurring subscription revenue from their Cricut Access software. Think of it like a Netflix subscription. It's the company's crown jewel for sure. Paid subscribers grew a really healthy 6% and are now over 3 million strong. That's fantastic. But on the other side, you have the products business. This is the physical stuff, the cutting machines, the vinyl, the materials. It's got much lower margins, and it's totally exposed to things like competition and whether or not people feel like spending money on crafts.
And this chart really just lays it all out, plain and simple. You see that platform revenue? Up a solid 7% year over year. Awesome. But look at the products revenue. It actually shrank by 3%. So what's happening is that beautiful, high-margin subscription business is basically papering over some serious cracks that are showing up in the physical goods side of the house.
And if we zoom in even further on that products segment, we find the real canary in the coal mine. It's the accessories and materials. You know, the vinyl, the blades, the stuff people buy over and over. Sales there absolutely cratered, down a whopping 17%. And to their credit, management didn't try to hide it on the earnings call. They came right out and said they're losing ground to the competition. This is the anchor that's really dragging the whole ship down.
But you know what? That weakness in the products business, that's not even the whole story. The real reason the stock got hammered is because of what management warned is coming down the pike. And this brings us to the big one, the tariff headwind. This right here is the smoking gun.
Yeah, management could not have been clearer about this on their call. They basically put up a giant warning sign saying that higher tariff costs are going to start eating into their profit margins, and it starts this quarter and gets even worse in 2026. You know, Wall Street is all about the future, and that single statement is what sent an ice-cold chill down investors' spines.
And we're not talking about a small problem here. This is huge. Look at this, roughly 3/4, 75% of all the money Cricut spends to make its products is exposed to these U.S. tariffs. This isn't some little line item, this is a direct shot at the heart of their profitability.
So let's put some real numbers on this, okay? The specific issue is Section 301 tariffs. And inside the company, management is running their models assuming they're going to have to pay an average tax of about 20% on all that stuff. And like I said, the clock is already ticking. The financial pain starts hitting the books in Q4. So it makes perfect sense, right? Investors look ahead, they see this giant margin problem coming, and they sell the stock today. All right, so where does all of this leave us? It's time to put it all together and give our verdict. We have this fantastic, high-quality subscription business on one side,
and this really clear, really scary headwind on the other. It's a real balancing act.
Okay, after weighing all the evidence, we're calling this one market perform. Basically, neutral. We just don't see a clear reason for the stock to outperform the rest of the market right now. But at the same time, that solid subscription business should provide a pretty nice floor under the stock price. And here's why we landed there. In the pro column, you've got that amazing, high-margin subscription engine chugging along. Plus, their balance sheet is a fortress. We're talking over $200 million in cash and absolutely no debt. That's awesome. But then you look at the con column. That collapse in accessory sales is really, really worrying. It shows the competition is real, and that tariff cloud is just hanging over everything, creating a ton of uncertainty for their future profits. It really just feels like the good and the bad are perfectly balanced at the moment.
All right, let's wrap this up with a little something extra, a trade idea. Now, given this really unique setup, here's a creative, kind of hedge fund style way you could think about playing this.
So the idea here is what's called a pairs trade. You're trying to isolate the good part of the business while protecting yourself from the bad part. So you would go long Cricut stock, you'd buy it, to capture all the upside from that awesome subscription platform. But at the same time, you'd short or bet against a broad consumer goods ETF, something like XY. What this does is let you bet on Cricut's unique software story, while at the same time betting against the general consumer weakness and tariff problems that are hurting their hardware and a bunch of other companies too.
So there you have it, a really strong headline number that was completely overshadowed by a weakening products business and, more importantly, a huge tariff threat looming on the horizon. That's our breakdown of the Cricut quarter, and as always, please remember, this is not financial advice.